Hello, everybody. Um, as you see, I am in an airport. I am in Copenhagen Airport this morning. Far too early for me, but I'm here nonetheless. I'm flying to London to do a presentation today on the outlook for global emerging markets, and I thought actually I would use this opportunity to give a little bit of an update on how I see things right now, particularly after the FOMC rate decision yesterday. No big surprise from the Federal Reserve. We got another 25 base point rate hike. Return to that, but talk about how I see the Fed, where we go from here, my concerns, and then implications for emerging markets. So, what's the story? The story is that obviously we got another rate hike yesterday, um, and a change in communication. There was a lot of focus on the word of accommodative or not accommodative. I can say we ran the FOMC statement through our forward guidance indicator algorithm. What we essentially do is we're counting words. We're counting how many hawkish and how many dovish words there was in the statement. And actually, the statement based on this was slightly less hawkish than earlier statements this year, and in such a way you could interpret it, the statement actually as being relatively dovish. Also, given the macro situation, inflation outlook, growth outlook, uh, I think the statement wasn't particularly hawkish, if anything, slightly on the dovish side. And obviously, this is how markets reacted initially to the statement. We saw the dollar weaken a little bit. We saw equities rally um, slightly. But then, of course, once Jerome Powell started his Q&A, that turned around. His statement was seen by the markets apparently, or his answers to the questions was seen as slightly hawkish. I must say this wasn't the best performance of Jay Powell I've seen. He seemed quite uncertain. He sounded uh, not too willing to commit to anything. If anything, it was mostly about uncertainty about this and uncertainty about that. He didn't know what assumption they had about fiscal policy, where the long-term interest rate would be, the R star. He was raising a lot of concerns regarding essentially the Fed's own assumptions. Obviously, we know that a lot of uncertainty about that, but I would have liked him to much more be to the point in terms of what policy rules the Fed is following. I'm earlier praised him for trying to do that, but I think he's moving away from that, and now essentially trying to get through the press conference without saying anything. So fundamentally, one could argue, well, wouldn't it be time just to give this whole thing up and just simply uh, state what policy rule you follow, and then let the market data or macro data as they come in determine the rate outlook. And maybe that is exactly what he was doing. So where are we in terms of that? Well, I think the market is more or less rightly priced. We'll get another couple of rate hikes this year and maybe a couple of rate hikes next year. So, but market pricing, I think, is pretty fair given the macroeconomic situation. Obviously, there is still this huge divergence between market pricing, uh, which, by the way, is very close to what we stipulate by a policy rule like the Taylor rule going forward, given the assumptions or consensus assumption on growth, unemployment, inflation, so forth. Then the market expectation is pretty close to a standard Taylor rule. Um, but but if you look at the FOMC dots, we continue to see significant heights, and the Fed continue to signal that it plans to send the U.S. economy into recession, or at least invert the yield curve, because it plans to, according to the Fed dots, to raise its policy rate above what is the level presently of 10-year yields. So that would imply inversion of the yield curve, and that normally, at least since the Second World War, has meant that within 24 months there will be a U.S. recession. Obviously, the Fed dot do not mean that this is actually what the Fed will deliver. Then the markets would be priced for that. But nonetheless, it tells you that that's still the direction of the Fed, further rate hikes. And what you would see is that the Fed intend on continue to rise rates, and I think that the Fed essentially continue to rise rates until the market reacts negatively to it, until we get a larger sell-off in the U.S. stock market. I think that is when the Fed will pause. When that happens, it's hard to say, but when it becomes more clear that the Fed will invert the curve, then that will likely happen. And we are very close to inverting the 210 yield curve, and so frankly speaking, that worries me a great deal that the Fed is not more worried about that. I revisited what Ben Bernanke said about the yield curve back in 2006, and the language of Ben Bernanke there is eerily similar to what some Fed officials are saying now about the yield curve. And of course, we know what happened 2 years later after Ben Bernanke said that you shouldn't worry about the inversion of the yield curve. In fact, the USA economy went into a very serious recession. In fact, the worst recession since the Great Depression. So, so that's clearly a negative. So the Fed is, I think, just thinking it should raise rates and will continue to do so until we get a major market reaction, as we did, for example, early 2016, when the Fed then softened its rhetoric following that. And I could imagine a similar thing here. So we are very close to inversion of the yield curve. That does not mean that the Fed will eventually push the economy into recession. It does not even mean we invert the yield curve for permanently, but it do mean that we are on the edge of doing that. And so, why is the yield curve important? I have got this question from clients recently. Say, yeah, we can see there is a historical relationship between a yield curve inversion and a recession, but what's the transmission mechanism? Why does it happen? I have planned to write a paper on this, but since I'm in the airport right now, I might as well give you the condensed version of that paper. To me, an inversion of the yield curve tells you something about whether monetary policy is becoming excessively tight or not. Or maybe I should say monetary conditions rather than monetary policy. I think a good way to think about the yield curve is to think that long-term yields, 10-year yields, 30-year yields in the US, is determined by market forces. It's determined by fundamental structural issues in the economy, such as demographics, productivity growth, and so forth, savings. So the long end of the curve very much reflect where yields would be had there not been any monetary policy. It had in a cashless economy, the implied interest rate there would be similar to what we have in the long end of the curve. The short end of the curve also reflects this, what we call the what we could call a cashless short market, short rate market rate. And essentially, the Fed is conducting monetary policy by targeting short-term interest rates. It's essentially trying to track what that cashless short-term market rate would do. So that rate would tend to follow something similar to a Taylor rule, move up and down with swings in economic sentiment, economic activity, inflation pressure, so forth. And that moves up and down for all kinds of reasons. Um, and the Fed trying to shadow that by moving its Fed target rate up and down with that. As long as it hits that, it does not create any negative or positive monetary impulse to the economy. However, if it tried to diverge from that cashless market rate, how could it do that? Well, imagine for some reason economic sentiment is improving, productivity growth is picking up, savings are coming down. That should move up this cashless market rate. So the Fed will have to move in line with that. That's what they have been doing in the last couple of years. So when it's doing that, at some point that might not continue. At the moment, the market is actually saying that it should stop relatively soon, within 2 or 3 rate hikes. But imagine then the Fed wants to push the actual money market rates, the Fed funds target rate, above that rate. How will it do that? Well, it can do that by simply taking out liquidity of the economy. So what we see is that when the Fed, for some reason, push the actual policy rate above what would be the market rate, then it's doing so by taking out liquidity of the money market, taking out liquidity of the economy, and that is a monetary contraction. So that is, in my view, what will happen is that when it pushes too aggressively on that, you push your short-term rates, money market rate, uh, above what is the, so to speak, the natural rate, which is best tracked by looking at longer yields. And how it does that is by taking out liquidity, and therefore we would see that when there is a divergence between the cash-free market rate and the policy rate, that would lead to a contraction in the money base. So far, we haven't seen that. Obviously, we're seeing the money base decline due to the quote unquote normalization of the Fed's balance sheet, but essentially we haven't seen a shock to the money base due to an attempt to push up yield rates. So that indicates that the hikes the Fed has implemented so far has more or less been in line with the underlying development in the short run cashless market rate. So no monetary shock yet. And other implication, however, if this happens, and the market's expectations, market participants would expect this to happen. There's another measure. We should look at money demand, because if I expect the Fed to make a hawkish mistake, so to speak, to push the policy rate above the cashless market rate, then I would start to demand dollars. I would increase my money demand because the value of the dollar would go up as the supply of dollars becomes more scarce as the Fed tightens. So that's another mechanism. So if the market expects the Fed to make a mistake, for example, because the Fed communicates that, then dollar demand will go up, and consequently money velocity will decline. So that's another form of the transition of this. Uh, the third way this could happen is that if banks and financial institutions expect the Fed to make a hawkish mistake, to push the policy rate above the cashless rate, then they will stop lending out. So the consequence of that will be a decline in the money multiplier, which would also be a monetary contraction. So I see these three channels through which we get a monetary contraction, and what the inversion of the yield curve is telling us is that one of these factors or more of these factors will play out. We're not seeing that yet. We can't see that. We track that in what we call a monetary shock indicator, and there's no indication yet that the Fed have diverged from the cashless free market rate. But there's a risk that that could happen, and it happened in 2007-8, and have happened essentially before any recession in the U.S. since the Second World War. And there's clearly a risk that that could happen again. It's not given. I saw my good friend Scott Sumner write on his blog, The Money Illusion, that it was not given just because it happened historically that they would make the same mistake again. But I must say that I'm less optimistic than Scott. I do think that an inversion of the yield curve would be a pretty clear signal that we would be heading for a U.S. recession and then in the next 24 months. So we're bordering that. And so what I'm going to talk about in London today is essentially the implication of that potential tightening of the credit cycle or continued tightening of the credit cycle. We have recently worked quite a bit with, um, so to speak, translating our global monetary indicators into a market-based indicator, what we call a global liquidity indicator. Global liquidity indicator is a measure of global liquidity. It is composite index of commodity prices, of the dollar, of credit spreads, of the yield curve, and so forth. Things we know coincide with Fed communication, global monetary conditions. Um, this global liquidity indicator has been turning downwards since February, March, and clearly indicating a tightening of global monetary conditions. And I think that has played a very significant role in the sell-off we have seen in emerging markets this year. That being said, what I also would say at the conference today is that what we've seen in Turkey and Argentina seem to be, to a large extent, also idiosyncratic shocks, specific Turkish and Argentine problems. A way to illustrate that is to look at the performance of the Turkish markets in 2000 and 17 and 16, there you saw also underperformance relative to emerging markets in general. So there are clearly specific issues. But also, if we look across emerging markets, it seems clear that there is a connection between the tightening of liquidity and the performance of emerging markets. The way I illustrate that today is to look at two periods. First, we look at the period from early 2016 to February, March 2016 until February 2018. Those 2 years, we had essentially a situation where we had a positive momentum in global liquidity. Global liquidity conditions was easing. If we look at the performance of emerging market currencies versus developed market currencies, we see a very clear positive or negative correlation, meaning that actually those that emerging markets were performing better on a relative basis than developed markets. You could say buy low quality, sell high quality, quality measured as institutional strength, income levels, historical macro and financial volatility, macro fragilities, and so forth. If we look at these broader qualities of different countries, we see that from 2016, 17 going into 18, the low quality countries, weak institutional framework, low income countries, their currencies actually tended to perform better than the high quality countries, the Switzerlands of the world. However, from February, that has essentially changed. Now the relationship has changed. So there's now a positive relationship between quality and the performance of currencies, meaning high quality countries, highly rated countries like Switzerland, like Sweden, uh, like, yeah, well, any developed economy as performing significantly better on terms of FX performance and also of the other markets than emerging markets such as Brazil, such as Russia. So we see that the relationship between quality and FX performance have twisted as we have moved from easing phase in monetary policy to a tightening phase in global monetary conditions. And I think this is very, very important. And the question is, where are we now? And I can't help feeling that we're in a kind of 2006 to 2008 situation. As most of you likely remember, is that in early 2006 and through the summer of 2006, we had actually quite a bit of jitters in the global markets. We had emerging markets sell off in the summer of 2006. I remember very much what happened in Iceland in early 2006 and the summer of 2006. Uh, but at that time, that came after some Fed tightening for a prolonged period of Fed hikes, rate hikes. And at that time, the Fed paused, changed communication a little bit, um, and then markets rebounded again. And then in 2008, we turned around again once it became clear that the Fed uh, were going to make a hawkish mistake. So see a little bit of the same potential now. We can also compare this to the situation in 95, 96, 98, and then until 2001. At that period, of course, emerging market crisis in Asia in 97, crisis in Russia in 97, caused the Fed to become more dovish, even though the US economy essentially didn't need that kind of dovishness from the Alan Greenspan Fed, but that was nonetheless what Greenspan delivered. He then, so to speak, inflated the U.S. economy, as I would say, inflated the stock market bubble at that time. We then burst it in 2001 once the Fed had started to tighten again. So I see a little bit of that. I see potential for a situation where eventually the Fed will cause the U.S. economy to move into recession. Eventually, that will have rather significant implications for emerging markets. But there is an interim period where the Fed might go back and forth. But the problem here, where the situation is very different from early 2016, is that in early 2016, the Fed was tightening monetary policy too easy for the good of the US economy. Now, our inflation forecast is exactly at 2% on a 2 to 3 year horizon. The Fed is perfectly on track. Unemployment is likely below its natural rate. So the Fed does not need monetary stimulus, doesn't need monetary contraction either. It's pretty much perfectly calibrated. But it's hard to see in this environment that the Fed wouldn't continue to hike rates. And the risk likely is that they make a hawkish mistake rather than a dovish mistake in the medium term. So that will continue to just sour the sentiment for emerging markets. If you go back to our global liquidity indicator, that's continuing to decline, but it's actually seemed to have flattened recently. So the decline isn't as steep anymore, but we are still not in a situation where the momentum measured as the actual global liquidity indicator relative to a 6 months moving average, the momentum still hasn't turned positive, but it's turning more neutral, and we can see that emerging markets is rebounding. Um, but I'm still not sure that we have turned the corner, particularly because the Fed don't really has any reason to ease monetary policy. It don't have a reason to tighten monetary policy dramatically, meaning hiking rates further than what is priced by the market. But 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 I think the risk still is for more monetary contraction, more liquidity contraction, and that means that the risk on emerging markets still is on the downside. But we are entering a more neutral phase than earlier in the year. Um, Also, maybe interesting, earlier in the year, our inflation forecast for the US was pointing to the Fed likely overshooting an inflation target in the medium term. That's no longer the case. With the rebound in the dollar and other factors in play, the flattening of the yield curve and so forth, we are now seeing inflation essentially in line with the 2% inflation target
Good morning,
on a
ladies
2
and
to 3
gentlemen.
percent
Welcome on board this
2
very
percent
early
year
2:09 past
horizon.
London Gatwick. We are ready
So
for boarding.
now I'm
Please
boarding.
have your boarding pass and
Thank you very
passports
much.
ready for inspection.